Hello, good morning, and welcome to another live technical analysis. Starting off with the euro against the US dollar. So, in terms of financial releases, the US ISM non manufacturing PMI figure that was released yesterday during the American session came in better than expected, which may be supporting the US dollar. In terms of technical analysis, I'm going to be starting off with the RSI. So, the RSI is at 33, implying a bearish market sentiment. Moreover, if you look at a support level, it's broken below S1. But I would personally bring S1 to become R1 at a slightly higher point, reflecting the recent price action at 1.075, 075, perhaps 0, or actually 1.0752 to coincide with the closing of this bullish candle and the opening of this bearish candle. So then I would switch my R2 to become R3, excuse me, R1 to become R2. And for R3, we could actually bring it slightly closer, taking this previous high upon which the downward trend line continued to validate and moved lower. Now, it could be said that R2 and R3 are fairly close to each other, but if it does manage to break above R2, then we might see the bullish momentum waning if it does reach to R3. And as such, for now, we can keep our support, our resistance levels as we just mentioned. So R1, 1.07, 1.0752. So you have R1, R2, and then we have R3, 1.08920, 8920, and R3. In terms of support, now in terms of support, so we're on the 4-hour time frame. You can see support being tested. I'd personally bring our support level slightly higher. So I'd like to see more touches. And what do I mean by touches? You have 2 wicks, the closing of this bearish candle, slightly the opening. Then you have 1, 2, 3 candles being validated, and a fourth, and perhaps slightly a fifth candle. So my S1 would be slightly higher at 1.0665. So that would be my S1, 0.0665. S2 could be kept at 1.0570. So that would be our S2. And then for S3, need to go back and take this previous low, multiple touches, equidistant between S1, S2, and then S3. So giving it some room to breathe should it break below S1 and S2. Now, in terms of financial releases, nothing too major is due today, except the Fed officials, so monetary policy. Now, Kashkari and Cleveland Fed President Messer are due to speak later on today. Based on the recent interview given by Fed Chair Powell, I would not be surprised if both Fed officials appear to be hawkish in nature, i.e., implying that rates may have to be kept higher for longer, so pushing back the expectations of the current 5 rate cuts. And we would be even less dovish than that and imply that they might come in at 3 or 4, as was indicated by the dot plot. For now, from a technical point of view, RSI 34, bearish market sentiment, the dollar appears to be gaining. So should the Fed officials sound hawkish in nature, the dollar could potentially gain against the euro, the pound, the Japanese yen, and so on. So target would be S1 for our bearish outlook to continue, aiming for S2 at 1.0570. Lastly, you have S3, which we need to readjust now with our new support line, 1.0458, actually 1.0459, since we're going to be rounding it up. 0459. So you have S1, S2, S3. Bearish outlook to continue would have to break below S1, aiming for S2. Lastly, you've got S3. Now, for a bullish outlook, simply breaking above R1 would not be sufficient. As you can see, the mid-range of the Bollinger Bands is in between R1 and R2. So it could correct higher above R1 to the mid-range before continuing on its descent. So for a bullish outlook, we'd have to break above R1 and R2. And since we're actually placing that as a condition, I'd actually bring R3 slightly higher, 1.0925, just in case it does manage to break above R2. R3 would have been far too close. So readjusting that, 1.0925 for R3. Financial releases stemming from the Eurozone, relatively muted day, so perhaps ceding control to the US dollar. From a technical, we would maintain a bearish outlook for the particular pair. Dollar against the JPY at R1, if not broken slightly above R1. Readjusting R1 to represent these two wicks. I'd bring S1. Actually, we need to see about S1. So for R1, 148.88. That would be R1. And then you have R2 of 150, R3 151.85. For support, we can have a few options. But if we're going to leave $2 in between S1 and R1, it could be fairly wide. But based on how it's been moving, 146.35, that would be my S1, simply representing bearish, bullish candle, bearish close, and the opening of these candles validated by the bullish wick before it moved higher, finding resistance. There are size at 65, implying bullish market tendencies. So based on what we said before for the euro, we're translating that over to the pair of the US dollar against the JPY. So if they do sound hawkish, breaking above R1, next target being R2. So we would be bullish on the dollar against the Japanese yen. Whereas bearish outlook breaking below simply S1 would be sufficient. Next target for the bears, 144.45. Now, cable is an interesting story. Chief economist Pill yesterday implied that rate cuts are not a matter of if, but when. So they are going to occur according to Mr. Pill. The question is when. Now, it should also be noted that despite saying this, he also did say that they have not seen enough progress on inflation for it to be justified yet. So it appears that the markets may have taken the dollar strengthening, weakening the British pound, but if they adopt a more hawkish tone, I would not be surprised to see it coming back up to R1 and R2, so staying in between the sideways channel that we had formed all the way since, let's see, the 13th of December 2023. For now, though, from a technical point of view, appears to be in a downwards fashion. Bollinger Bands being tilted towards the downside, but once again, we would like to see the pair remain below R1 for our bearish outlook to continue, and it has to break below S1. If it breaks above R1, then we would switch towards a sideways bias between R1 and R2, whereas for bullish outlook, it would have to break above R2. And why am I saying sideways if it does break above R1? Just look at the sideways moving channel. If it enters this range, it could potentially stay within this range. For a sideways bias, if it does not break below above R1, stay in between S1 and R1. Note that their RSI is at 30, implying strong bearish market tendencies. So I have S1 1.2445, S2 1.2310, then you've got S3 at 1.2205. So bearish outlook, but I would like to see it test R1 and then moving once again below and breaking below S1. In terms of the dollar against the Canadian dollar, so we're actually going to be looking at oil first before we look at the dollar against the CAD. So we move on to the 4-hour time frame for oil. Downwards moving trend line has been violated and is staying in between S1 and R1. So you've got 70.25, you've got S2 at 67, S3 at 62.25. Tensions in the region are still high. And what do we mean by high? Well, there are continued strikes by US coalition forces in Yemen against targets. Then you have the retaliation by the US in Syria as well. So geopolitically, the tension is still volatile. So oil prices may have found some relief, so alleviated the downward pressures on oil price, staying sideways. RSI still at 39, so it's bearish tendencies. But for our bearish outlook to continue, we'll have to break below S1. For now, I would not be surprised if it stays between S1 and R1. The difference between S1 and R1 is significant. It's about $5. Therefore, could potentially move up to R1, fail to break, and then stay between S1 and R1. What is interesting is that there appears to be a crossover between the 50 and 100 moving average. So 100 moving average moving above the 50, which could imply a bullish signal. So that's why I would not maintain a bearish outlook for now. For a bullish outlook, though, you have to break above R1, if not aiming for R2 and breaking above R2. Bearish outlook, simply breaking below S1 would be sufficient. In terms of technicals, it's broken a downward moving trend line, staying between S1 and R1. Pure apparent smoothing of the Bollinger Bands could imply low market volatility for now. So staying between S1 and R1. So sideways bias for oil. In terms of gold, let's move on to the 4-hour chart. Now for oil, gold, excuse me, I have multiple touches, so validating this is an upwards moving trend line. Narrowing, well, the smoothing of the moving averages, failing to break below S1 at 2013. And you've got 2039 as R1. Sideways bias as well, RSI 40. It's not near 50, but it's not near 30 as well. So it's in between. So it could be some bearish market tendencies, but it's in between S1 and R1. I would maintain a sideways bias for the precious metal, at least for today. But if Fed officials, so Kashkari and Messer, appear to be hawkish in nature, would not be surprised if the precious metals breaks below S1 and aims for S2. Why? It's denominated in the US dollar. So if they're hawkish and the dollar gains, the precious metal could weaken. Whereas oil could be dictated by the API weekly crude oil inventories figure that might be released later on today, which should imply greater demand than expected, providing some support, or if tensions heat up, higher. But if they remain relatively calmer, staying between S1 and R1. Whereas, should an increase in oil inventories occur, so implying lower demand, we may see oil weakening. So moving back to the Canadian dollar, if oil's price increases, we may see some strength from the loonie, given that it is an oil exporting nation. For now, it appears to be testing R1 at 1.3540. We have S1 at 1.3410. Could be said that it's moving or forming an upwards moving trend line. So we could have two touches. We would like a third for this to be validated as well. But overall, will not be surprised if it makes a small market correction before breaking above R1. So given that it's denominated, that it's the dollar against the Canadian dollar, if the Fed speakers are hawkish, we may see the dollar gaining. But an increase in oil prices could alleviate some pressures on the loonie. So that depends. You have two scenarios. We're going to be looking at UBS, whose earnings came in lower than expected, so slightly concerning. Yet the $1 billion share buyback program could provide some support in the future. So you might be wondering, well, if your revenue is lower than expected, but you're announcing a share buyback program, why would that provide some support for the company's stock price, the bank's stock price in the future? Well, they might be rewarded from investors. If you're giving more, so you're buying back shares, so there is less in circulation, and you're reintroducing the 70 cents per share dividends, well, an investor might find that appealing. and as such, that could actually provide some support to the company's stock price. So we're on the 4-hour time frame. Now, it may move lower for the day, but overall, if I'm buying back shares and introducing the dividends, I would not be surprised if the bank stock price moves higher. Let me just remove these labels out of the way. So I'd keep S1 at 29. That would be my S1. Closest wick, moved higher. So I'm not going to be placing it higher as it's a bit too close. I'd like to get some room. So I have S1. Then I have S2. I've got a validation of 2 candles. So 27.62. And then for S3, where this gap was formed, 26.35. So I'm giving some space for the stock price to move within. So this would be my support levels. In terms of resistance, I take this recent high, 30.25. Then I take this high here. So I'll be noting just now some space, not as much as S1 and S2, but still some room to play. So you've got 31.33 for your R2. And then, if I'm not mistaken, we don't have any historical data. So for R3, we'd have to extrapolate the distance between perhaps R1 and R2 and then reflect it higher. So it's about 130, 105, and then 105, 32.20, 32.35. So I've got R3, R2, and R1. Overall, I would maintain a bullish outlook on UBS. They're integrating Credit Suisse. The loss was expected. Yet, based on their leadership, the buyback program, and the introducing of dividends, I would not be surprised if the company's stock price picks up and moves higher from a more macro perspective. So let's just put on the text labels to make it easier for you at home. You can see, then let's make this 16. We've got S1, S2, 27.62. We'll also be looking at BP, who I think was up about 3% today, also announcing a share buyback program. So that's providing support for the company's stock price. We're going to be doing a technical analysis on British Petroleum in just a moment. So you've got 26.35 for S3. Then for R1, we have 30.25. 30.25. Then you've got 31.33. You've got R3 at 32.35. Overall, as I've said, I would maintain a bullish outlook for the company stock price based on the introduction of dividends and the share buyback program. What is worrying, however, is the regional banking sector in the US. Now, yes, UBS is not American, but concerns about the banking sector overall could potentially weigh on European banking stock prices as well. So that's something to keep an eye out for. H4, so for our time frame, note this breakaway gap being formed. So the share buyback program by British Petroleum, so BP, hashtag BP as well. Now, this is a very interesting story. So where would we place our support levels? Would it be here? Would it be at this point? Well, it's gapped up. So my first level of support would be here. It touched twice, failed to break, and then moved lower. But following the announcement by the company, skyrocketed and is now at $479 per share. So that is interesting. So you'd have 470.87. That would be my S1. Now S2, this low. This is where the movement started. This is my first level of support. If it fails and breaks below my first level of support, my second level would be where this movement began, slightly lower. Here, slightly lower at this low. So 452.60, this would be my S2. So if it does come back down to fill in this gap, my S2 would be here. So it might meet support at here. Whereas I placed in between, there's still a gap that might be filled. For S3, let's move this. S3, I'm looking in between this, and this here. The first possibility, this I'm ignoring, it's too close to S2. This could be a support level. But note the difference that we're placing between S1 and S2, and then S2 and S3, far too close. Then I placed it here. We're ignoring potential support or resistance turn to support. So what we could do is find a middle ground. These two candles validated by this wick. Second, when it managed to break above, it moved higher. So this would be my S3, 438.50. Now, just because I've placed my S1 here does not mean we won't find support at this point here or even lower. Just means that based on the distance between S1 and S2, I find it likely or possible that there might be support at this point, a more immediate level of S3. In terms of resistance, now let's take what this candle has formed. So it wicked up, failed. So there's resistance. And if you can see, it's coinciding with the closing of the bullish candle and the opening of the bearish candle. So it came back up, found resistance here. So valid resistance level, 485.15. Then for S2, I'll take this high, failed to break above, moved lower. And then for R3, taking this previous low, broke down below. So if it does come back up, it could find resistance at this point. 520.48. For R3, I've accidentally removed R2. So you have R3, 503, just rounding it up to dollar. Let's just make sure that it coincides. Yep. So big figure, psychological as well, $503. $485.15 for R1. First level of support, 470.87. $452, so 152.60 for S2. Also be looking at the New Zealand dollar based on that their employment data is due to be released late this evening. So this is S3. Technicals, breakaway, steep RSI 67. So the next two candles finding support and then moving above R1, R2, then you have R3 as a final target, but would maintain a bullish outlook for the company at least for now. We've done oil, British Airways, and UBS, New Zealand dollar. Let's find the New Zealand dollar, USD, and as D. See, New Zealand dollar, US dollar. There we go. Let's add an indicator as well, something which we haven't actually done to UBS. Let's see, Bollinger Bands, slight sideways motion, but we said bullish based on the fundamentals. Extreme widening, so might be due market correction to S1 before moving higher. And New Zealand dollar for our time frame. Employment data. Employment rate for Q4 expected to tick up, which could weaken the New Zealand dollar. For S1, it's at 0.604. Taking this low for my S1. I'm taking that point as S1 as it's on support level now. So let's give it some room. R1. Then for R2, R1 is found resistance, validated resistance, and is moving lower. R2 at the beginning of this downwards motion, and then R3, this old low. Had I placed at this high, would have been, let's just place at this high. Still significant resistance level, failed to break above and moved lower. So have R1, R2, R3. Swing low, that's my support. Perhaps using here by this wick, so I'm keeping that as S2. For S3, beginning of this upwards motion, as you can see, equidistant from S2 to S3 and R2 to R3. So just in case it does break below S1 and S2, you've got S3 slightly further away. So for R3, 0.6255. You might be wondering why we always or usually round up our support and resistance levels. It's more of a psychological impact. So it is possible that people entering a trade won't look for uneven numbers. They might go for intervals of 5 or 10. So by rounding it up, for example, it could be more likely that someone might enter a trade at 0.614535 instead of 33, which is why we're also rounding it up. $0.6075. For S1, 0.6015. 0.5955 for S2, 0.5865 for S3. So you have S1, S2, 3, and then the resistance levels. Based on that, we're also expecting the dollar to strengthen, would maintain a bearish outlook for the pair. If it breaks below S1, RSI 37, bearish tendencies. Next target for the bears, S1, then S2. Bullish outlook simply breaking above R1 and moving towards R2 would be sufficient. So look at NVIDIA. Let's add an indicator as well. So Bollinger Bands, maybe some volume. Actually, let's look at the S&P and then the Nasdaq. Might be more interesting than looking at NVIDIA. Dow Jones 30, staying between S1 and R1, breaking the upwards moving trend line. So sideways bias between S1 and R1. Note the RSI is at 60, but it came lower, rebounded, and came back down. So bullish tendencies might be waning for the Dow Jones 30, and thus S&P and the Nasdaq might actually follow suit. Still staying higher. Apple's Vision Pro might be boosting its stock price. Appears to be a media campaign, or at least hype from um, consumers. So multiple videos circulating could provide some hype for the company's product, might boost the company's stock price. But let's look at the indexes. S&P 500 finding resistance at 4,915. Uh, Overall, it's still validating the upwards moving trend line. There are sides at 66, so one could say it's a bullish sentiment still persists in the market. Yet, if the dollar does strengthen, I would not be surprised for it to come back lower, back down to perhaps S1 at 4,800. Bullish outlook would have to break above R1 and move towards R2, as it is currently resting on R1. Then, if it breaks below S1, you've got S2 at 4,660. For the Nasdaq, we've already done. Actually, for the Dow Jones 30, we've done it already. For the Nasdaq, continues to still move in an upwards fashion, validating our upwards moving trend line. SI at 66. So you could be bullish on the Nasdaq. I think it's also driven by NVIDIA, which we're going to be looking at now. Just look on the monthly chart for NVIDIA. It's incredible. It's moving higher and higher and higher and higher. On the daily, $693 per share. All indicators point to a bullish market sentiment, yet 85. 85 is well above 70, so it might be due a market correction to lower ground. If you move on to the daily, breakaway continuation, maybe another gap before it becomes an exhaustion gap and then corrects lower. But let's opt for some technical analysis on the daily chart. I'm ignoring this. Come back lower. More support at 613.15, 0.10, round it down. For S2, take this previous high. So resistance turn to support, 504.30. And then previous low, 401.20 for S3. Now, for resistance, and yes, I am purposely leaving a significant amount behind because this is from more macro perspective. We're on the daily. And why? it's overbought, so it does come back down. It could break below S1, correct between S1 and S2. So that's why I'm placing it much lower. Then resistance 713.40. No mistaken, some analysts had a target of $700 per share. 833.70. That's my R2. And yes, so that was all-time high. Stock split. And then big figure 850 or 915. But 1.70. And then let's extrapolate. $955 for R3. Equal distance between, roughly an equal distance between S1, S2, S3, and then R1, R2, and R3. Overall appears to be moving in upwards fashion, yet 85 overbought might be due a correction lower, which in turn could actually weigh on the Nasdaq 100 as well. Let's see. Let's look at the Aussie. We've already done the Aussie, so let's see. What could we do? Well, we've mentioned Apple, so we could have a look at Apple. The Vision Pro is an interesting gadget. If there is enough hype, could boost the company's stock price. It's been getting a lot of attention on social media as well. So you have S1, 179.15. $166.80 for S3, taking this old high, 155.0 for resistance, recent high, 195.40. Stock split, so we're going previous point. Gapped up, came back down. Pound resistance, so 209.75. And then invalidated, so 212.20. And then for R3, between bearish candle, closed, came back up. So that's possible. R3, 228.85. 212.20 for R2, 195.30 for R1, S1, 179.15, S2, 166.80, 155 for S3. Technical point of view, upwards moving trend line, like another candle to validate this upwards moving trend line, psi 50, so sideways, unless it breaks above R1, then immediately bullish outlook aiming for S2, R2. For bearish outlook, simply breaking below S1 would be sufficient. And with that, does it for the day. Thank you for watching.
My name is Emily and welcome to another of our great educational trading videos. Today we're going to look at day trading. Day trading is a very popular short-term trading strategy that involves the buying and selling of financial instruments during the trading day in order to make a profit from small price movements. The most important rule of day trading is that traders need to close out all their positions at the end of the trading day. Generally, the day trader aims to take small profits that can add up during the day or trading period, while at the same time minimizing their losses. While day trading is a viable trading strategy for many experienced forex traders, beginner traders could find day trading to be challenging. Without a well-defined trading plan and the discipline to adhere to its rules, beginners might be overwhelmed by the stress of intraday trading. Day trading strategies can differ from longer-term trading strategies as they focus more on profiting from shorter-term movements in the market compared to moves that take place over a number of days or weeks. In this respect, day traders need to be continuously focused as markets can move suddenly in the short term. Overall, advantages of day trading include instant results and no overnight risk. On the other hand, the disadvantages include requiring a high initial deposit to make substantial profits, less time to think, and there is also a risk of overtrading. Thank you so much for watching us today, guys. Bye-bye.
Let's go ahead and get started. So for those who have just joined us, welcome to today's webinar. Today's session will be the third part of our Fibonacci series, and today's session will be on expansions. So let's go ahead and before we get started, as usual, a risk warning and disclaimer. So our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So I'm Melanie. I'm an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so here's our agenda for today. So we'll briefly go through a recap on what we've talked about recently, the past 2 weeks on Fibonacci retracement essentials, so what exactly you can look out for, and what constitutes an ideal market structure, so what exactly are significant swings, and what exactly are the market trends that you should be following. And then we'll look at the different Fibonacci retracement levels, and then we'll get into this week's Fibonacci expansions technique, followed by how we can combine what we've learned previously with what we're going to learn today, and combine them to form confluence levels. Okay, so let's get started with our Fibonacci retracement checklist. So some essential steps. Firstly is the market structure clear. So we want to look for big zigzags or big price movements. Secondly is to identify the recent trend, so are prices going down or up. And thirdly, we want to look for recent major swing lows and recent major swing highs, followed by connecting the two extreme points, so the highest and lowest, or the lowest to the highest point, if it's an uptrend. Okay, so let's look at what exactly constitutes a significant swing. So firstly, here, let's look at an incorrect example. So here we have insignificant swings. So you can see in the example here, these swing highs and swing lows are too insignificant. So they're too insignificant to use as Fibonacci points. Okay, because the price movements are too small and there's no significant price movements. So here's another example. You can't really see any significant shape. Okay, and here we have a significant example. So you can see that there are obvious peaks and troughs in our example here, and we've drawn it out. And there's also clear market movement. So this is the kind of market structure that you want to look out for when you are deciding which charts to trade. Okay, again, another example over here. Okay, next, let's look at how you can follow the market structure. So in this example, you can see that the Fibonacci trend line, which is basically the line that we've drawn here, cuts through the price structure and doesn't follow the shape of the chart. So Fibonacci retracement levels should not cut through too large areas of the market structure. The Fibonacci trend line should follow the shape and should not deviate too much from price movement. Okay, so what you should do is, like in this example here, where we're following the clear downward movement of the trend, and the Fibonacci retracement trend line follows the price movement. And this tends to work better on higher time frames, so H1, H4, daily, weekly, depending on your trading strategy. Okay, again, here's an example of a clear market structure. And this is an example of an unclear market structure. Okay, and here are the different Fibonacci retracement levels. So the negatives are what we are going to be looking at today, which is the Fibonacci expansion. And then previous weeks in our first session, we went through Fibonacci retracement, which would be from 0 to 100. And then those that are above 100, so 127.2 and 161.8, those we talked about last week when we talked about Fibonacci extensions. Okay. And yep, so here's an example of it on a chart. So here you can see all the different Fibonacci numbers that we mentioned in the previous slide and how exactly it looks drawn out. So you want to firstly take note of the starting and the ending point of our Fibonacci trend line. So you can see the starting point is up here, ending point down here. Okay, and as we mentioned, mid-range are the retracements. Negative range is our expansions, so what we'll be talking about today. And those that are more than 100% are the extensions. So in all these three scenarios, we are only using one tool, which is the Fibonacci retracement. Okay, so let's zoom in and look at today's Fibonacci expansion technique. So before we get into that, I just want to introduce to you guys a website that you can use if you're just starting out on Fibonacci techniques. Okay, so you can go on to the forexarmy.com and it teaches you how to draw the Fibonacci retracement correctly. So it goes through, there's a video as well on each of the techniques, and then you can look at what you can look out for. Basically everything that I'm going through today, you can also find on this website. Okay, so yep, there's some examples here. Okay, and they go through each of the Fibonacci as well. So you can see here, they're talking about combining the Fibonacci levels, which is what we'll talk about later on when we're talking about Fibonacci confluence levels. Yeah, and here we're talking about how kind of trade management strategies. So you place your stop loss beyond, take profit before. So this is quite an important concept that we'll talk about at the end as well. So yeah, just wanted to briefly mention that if you're just starting out, and yeah, maybe I'll just pop it into the chat. Okay, let me go back to my slides. Okay, so let's zoom in to this week's topic, which is Fibonacci expansions, and we're just going to be focusing on the negatives today. So using the Fibonacci retracement tool, we are making use of the negative levels, namely minus 61.8 and minus 27.2. So when using this tool, ideally we look for this flash, zigzag, or lightning symbol. Okay, so price should retrace at least 50% in 0.3 as shown in the video here before reversing off. So you can see in the GIF I've included here. Okay, our flash symbol is drawn out in yellow, and you're taking the starting and ending point, or point 1 and point 2, and we are observing the negative levels. So of course the first level we'll be observing is minus 27. So if price breaks out of the minus 27.2, then we would go on to look for the minus 61.8. But it's important to note that this 0.3 here should be more than 50%, which is over here where my mouse is at. Yeah, it should surpass that level before you can use this Fibonacci expansion technique. Okay, maybe I'll just pause here and let you guys watch the GIF a couple of times. Okay, so here you can see it's retraced even more, almost 76%. Okay, before bouncing off and heading towards our 27%, minus 27%, and retracing off of that level. Okay, so here's our first example. So here we can see how exactly it plays out. We have a starting and ending point here and here. Okay, and we can see the price retracing 61.8% of the retracement that we've identified. And then we see how to make use of the support in the negatives. So here you can see we have a minus 27.2 that we're observing. So we're expecting price to retrace back here, and we're expecting it to bounce off of this support level, which you can see in this example it did do. Okay, so typically once price breaks out of the 0%, that is confirmation that it's gonna hit towards your minus 27.2. A pro tip is that price usually does come back to the ending point, so the same level over here, and it might test that level since it is now a overlap support or resistance level. So basically, what a overlap level means is that if there is a swing low as well as a swing high that lines up in the same level like we see over here at this red highlighted area. Okay, so how you basically use this technique is basically expecting price to react off of the negative levels or your support levels and then expecting it to hit back to your ending point. So pretty straightforward, but let's look at another example here. So take note of this zigzag shape. This is point 1, point 2, point 3 here, and then of course point 4 here. Okay, so if we are looking at it, of course, this example is with hindsight, but if we're looking at it before, we would look for this flash symbol, okay, before it reaches the minus 27.2, and then we place this Fibonacci retracement level and then project it to firstly minus 27.2, and then we can see it breaks out, and then we will go in for buy towards the minus 61.8. Okay, we can see it reverse off and hit back down to this overlap level here. You can see the swing high here and another swing high here. So it's a pretty significant level, even though we haven't highlighted it yet, because multiple swing highs have lined up in the same area. So we can expect price to react off of that area as well. Okay, another example here. Once again, take note of the flash shape. Okay, it has definitely surpassed more than 50%, almost 100% over here. And then price is reacted off the minus 27.2% Fibonacci expansion level. Okay. Okay, another GIF for you. So the yellow arrow is the lightning bolt shape, and we are placing the retracement from point 1 to point 2 and projecting it to hit towards or reverse off of the minus 27.2. Okay, let's move on. Okay, so a pretty important point over here what makes an invalid Fibonacci retracement? So this is one of the most common scenarios where we see price making a lower low, assuming that you're drawing the Fibonacci retracement from the top to the bottom. Okay, so it's making a lower low, and there are bars on the right that break your ending point. It then becomes invalid. So there are Fibonacci retracements that are negative, like we've just went through in the previous slides. So those are valid. But if we are using a retracement, okay, I'll show you guys the example here. But if we're using a retracement from this starting point to this ending point, and we're looking for a mid-range, then this area, since it breaks out of the ending point, it is no longer considered a valid retracement. Okay, so price breaks our ending point on the right, and hence we cannot use this ending point as our retracement. So we want to always remember to pick the lowest point with nothing on the right of the ending point. So similarly, if you're looking at an uptrend instead of, in this example, we're looking at downtrend. So if the example is an uptrend, obviously you want to look for something that doesn't have a highest point to the right of the ending point. Basically this example, but flipped. Okay, now let's get into the fun part, which is looking for confluence levels. So what a confluence level means is basically when there are multiple Fibonacci retracement levels that line up together. So this increases the probability of a bunch of Fibonacci retracement levels working together versus a single Fibonacci retracement level. Okay, so okay, let me zoom into the example. So if you look at the red arrow, you can kind of see a pretty obvious lightning bolt shape over here, right? So the red arrow is our minus 27.2% Fibonacci expansion that we talked about today. And then our Fibonacci extension, which we talked about last week. Basically for that, you're looking for a Nike tick. In this scenario, we're looking at an upside down Nike tick or an inverted Nike tick where the head is the gray arrow and this black arrow is the tail. Okay, so for extensions, we're looking for levels that are above 100%, which we see over here. And that lines up with our Fibonacci projection. So for projections, we'll touch a bit more on that next week. But really briefly, for projections, we are also looking for flash or lightning bolt shapes. So typically, projections can be used with expansions quite a lot of the time. So for projections, we are looking at 61.8, 78.6, and 100% levels. So in this case, we see a 78.6% Fibonacci projection that lines up with all these other two levels. You can see since we have not one, but three Fibonacci levels lining in the same area, this makes it a very strong confluence area where we are expecting price to be attracted to it, but also bounce off of the area as well, because it creates a lot of resistance when multiple Fibonacci levels line up in the same area. Let's look at another example here. Okay, so in this example, price broke through the 127.2% level. Hence, we expect price to reverse off of the 161.8% Fibonacci extension and also the minus 61.8% Fibonacci expansion levels. Okay, so these line up and give us a very strong level. Okay. So like what I mentioned earlier, we would look for a retracement off of the minus 27.2 first before going in towards our minus 61.8. But once it surpasses, then we're going for a buy towards this level. especially since, we have these two levels lining up. Okay. Yep. In our next example, here we have a minus 27.2% Fibonacci expansion, which is in blue over here. You can see the lightning bolt shape, I think. Okay, and then our Fibonacci extension, which again is the Nike tick, which is the purple arrow. Okay, in this case, it is also an inverted Nike tick. And then we also have a 100% Fibonacci projection, which is 3 points. So the starting point is here, middle point here, and ending point here. And those three levels all line up in the same area, which gives us this very nice confluence area where we can expect price to bounce off of this very strong support level. So one thing to keep in mind is that these tend to be areas instead of levels. So you can see even though our 127.2 is not exactly lined up with the minus 27.2, it still counts because we're looking for areas here. So as long as it's kind of near, it still counts as a confluence area. Because you can see here, when you have such a strong area, right, price is more likely to bounce off of it. So you want to make sure that you are able to catch that 1 or 2 pips before it reverses off. So that brings me to my next point, which is trade management. Briefly talked about this just now when we were talking about the Forex Army website because this chart is taken from there. But basically, this trade management technique helps you to make sure that you catch any reversals before it happens. Because those, like I mentioned over here, for example, you can see it doesn't really, it's just the wick of the candlestick that touches these levels. The actual body of the candlestick doesn't even touch it. So you want to make sure that you catch these levels before they reverse off of them. And this trade management technique helps you with that. So firstly, you want to make sure that your stop loss is placed beyond a key Fibonacci confluence area. Reason for this is because more often than not, price is attracted to such strong areas of confluence. And if your stop loss is right before, instead of beyond the level, chances are you'll most likely get stopped out before the market reverses. And that's one of the reasons why people wonder why they got stopped out right before the market starts to reverse, and they might start complaining about stop hunting. Okay. And for your take profit, rule of thumb is to place your take profit before your key Fibonacci confluence area. Again, the reason for this is because when price reaches the Fibonacci confluence area, there is a high chance that it won't be able to go beyond of it. So instead of reaching your profit target, it reverses back to your entry, or even worse, your stop loss. So that's one of the reasons why people complain that the market might be manipulated, because they miss their take profit by 1 pip. Okay. Okay, that's it for our slides. So now we're gonna go into our live analysis session. So if you guys have any requests for any charts that you guys would like to see, feel free to pop them into the chat. Okay, I'm just gonna open my charts while you guys pop your requests into the chat. Okay, to get the ball rolling, I think I'll just start off with gold. Okay. Okay, sorry about that. Had some technical issues. Um, let's go ahead and get started with gold first. So let's look at our weekly time frame first, just to get an idea of where prices are headed towards. So we can see that gold is pretty bullish. Okay, let's see if we have a channel. Okay, not really. Okay, but we can see that prices are headed upwards. Okay, even though there are no trend lines or trend channels. Okay, let's look at our daily time frame now. And firstly, our first step is always to look for any trend lines or trend channels. Okay, just to see if we have a general direction. And you can see that price is moving within this ascending trend channel. So just to recap really quickly, what makes a valid trend channel is if there are two touches on top and two touches at the bottom of the trend channel. Okay. Okay. So let's go in and look at our support and resistance levels. So here will be my first support, and here would be my first resistance. Okay. Okay, so typically we will follow trend, and we can see that price is bouncing off of the um, trend channel. Okay, so following that trend, we are expecting it to hit towards our first resistance. Let's look at our 4-hour time frame now. Okay, on our 4-hour time frame, our first resistance would be a little bit closer to where price is at, which is over here. And you want to try and pull it back as far as you can, just to see if you can spot any significant levels. So here, I'm pulling it back all the way here so that I can see that I have one swing high and two swing high here. Oh, okay. Okay. So that's our first resistance. And I think our second resistance would be here, since it is a double swing high. Okay, let's go in with some Fibonacci levels. Okay, so starting off, let's go in with a projection. So this is my starting point, middle point, and ending point. Okay, and for projections, we use 61.8, 78.6, and 100%. Okay, so I'm just gonna have all of those levels first. Next, I'm gonna be taking a retracement because I want to see if I have any levels that line up with our projection, which you can see that is over here. Okay. Okay, so this is going to be a intermediate level. Okay. Because that's exactly where price is at currently. So we might be seeing some resistance here since we have two levels lining up, and this is also a overlap level. So overlap because there is a swing low as well as, so actually we have a couple of swing lows as well as a couple of swing highs. So it is a pretty significant level. Okay, and gonna be using another projection level. Okay, and that supports my first support level. And okay, let's see if we can find any expansions. Okay, so earlier we mentioned minus 27.2 and minus 61.8 are the levels for expansion. And you can see that, oh, so this is our lightning bolt shape in case you couldn't see it. Okay, and I can see that I have a minus 27.2 that lines up with, let's see. Okay, it doesn't line up with anything. Okay, but my minus 61.8 lines up nicely with my second resistance. So I'm still going to keep this level just in case price bounces off of that level. Okay, but for now, we are going to see price testing our intermediate resistance first, and we're expecting it to continue to move up towards our first resistance. Now let's pull out some indicators to support our analysis. So price is on our Ichimoku, looks like price is moving within the cloud. So if it moves within the cloud, it doesn't really tell us much. Although it does look like it's moving, it's exiting out of it if you look at the wick of the candlestick. But before that happens, we can't be too sure. So I'm going to remove that. Okay. And for our MACD, you can see it's giving us a bullish signal. So that's good. And if we look at RSI, okay, price is also moving in an uptrend. So that supports our analysis as well. And on our stochastic, it's also an uptrend. Okay, and let's maybe look at Bollinger Bands. Okay, it's not really telling us much. Moving average. Okay, price looks like it's moving above both of the averages. You can see the red wick is starting to move above our green EMA. Okay, so that also supports our analysis. Okay, so that's for gold. I think we have time for maybe one more chart. Okay, let's go ahead and look at the Aussie dollar. So on our weekly time frame, uh, it looks kind of bearish, okay, with price moving in this descending trend line. So again, just to recap, what makes a valid trend line is if there are at least 3 touches on the line, which you can see we have over here. On our daily time frame, mm, it also looks kind of bearish, even though we don't have any um oh, actually it's currently breaking out of this descending trend line. Okay, so we have a really nice trend line over here. Okay, 1, 2, and 3 touches, and you can actually even fall over here. You can see price recently broke out of the descending trend line. So there is a bit of a bullish signal over here. Now let's just go ahead and add some support and resistance levels again. Okay, so this is my first support. Second support. Okay, this will be my intermediate level because we can see there's 1, 2, 3, 4 swing lows that line up with that level. Okay, so this is my intermediate resistance. Uh, okay, and over here is my first resistance. Okay, now let's look at our 4-hour time frame. Okay, now you can see on our 4-hour time frame, it looks significantly more like there's no real trend. Okay, it's ranging here. So that's why it's important to look at the higher time frames first and then zooming down to your lower time frames. Okay, here will be my first support. Actually, maybe here instead. Okay. Because it's closer to where price is currently at. Okay, and next will be my first resistance over here. Okay, going in once again with our retracement level. So I like to just look at all the Fibonacci levels first. Okay, and then seeing what matches up. Okay. So for projection, we use these 3 levels. And you can see they kind of line up nicely. Okay, I think my 50% kind of lines up with my first resistance. Okay, so I'll just keep that. Okay, just a recap. Here we have, this is an example of a Nike tick. Oh, where is it? Okay, here. So you can see the head of the Nike tick here. and the tail here. So in this case, we can see price testing the 127.2 level, but ultimately it did break out of it. But yeah, just wanted to show you how to identify the shape. Okay. Um, okay. I think that's all the levels that we have. Um, okay. I think that's all the levels that we have in this case. Oh, let's see if we have an extension here. Okay, so we can see the minus 27.2 lines up with the 127.2. But that's a bit far from where our price is currently at. So I'll remove that. And I will also remove this. Okay, just so that it's not so messy. Okay. Okay. Now let's look at some indicators. So price is moving below the Ichimoku cloud, so it's giving us a bearish signal. Actually, it's moving within a cloud, so we can't even use that. And for our MACD, it is giving us a bullish signal, which supports our analysis. Okay. This is my first resistance. So we're expecting price to go from our first support. Maybe there will be some resistance over here at an intermediate level. Okay. Uh, let's briefly see if there's any levels that line up. Okay, my 23.6 is quite close to where we are looking at. Okay, for our intermediate level. Okay, so we might see some resistance over here. Okay, let's look at our RSI and stochastic. Okay, they're both not telling us much. Now let's look at uh, Bollinger and MA. Okay, Bollinger isn't telling us much. Price is moving above our SMA, so in the short term, it does look like price is going to move upwards, but it is moving below the EMA. Okay, but you can see that price crossed over here when price started to make a downtrend. But now that it's making an uptrend, we might be able to see this crossover. So basically, when the EMA and SMA cross over, it is a signal that the trend will change. So we might see that soon. And yeah. Yeah, so for this, we might see some resistance here. Okay. But ultimately, there is quite a bit of upward pressure that could push it past this resistance level here towards our first resistance. Okay. Do you guys have any questions? Any other requests? Oh, good. Okay, great. If there are no other requests or any questions, then that's it for today's webinar. Thank you guys so much for joining me, and I hope you guys found it helpful. Have a great rest of your week, and I'll see you guys next week. Bye, everyone.